This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
So that gets on to chapter 19. This is a very high probability of coming up. It can either come up as its own right. The examiners do actually say, don't get me wrong here, the examiners do actually say that there is a lot of evidence of question spotting by students. And question spotting is a very dangerous activity because basically you can't spot what the topics are going to be. I have not a clue what he's going to ask in question 5 and now question 4. No idea about the 10 marker and the 15 marker at the end of the exam. I have no idea. I will guess. I'll make some guesses for you on the revision course, just on the balance of probabilities and what has not come up recently. But it's only a guess. And the examiners consistently, pretty well all of them, say there is a lot of evidence of question spotting by students. This is a very dangerous activity and can be seriously damaging to your health. So, well, not health, but your chances of success. Because if you spot the wrong ones and you don't do any other work, then you're struggling. So, that aside, question 3 is always either a cash flow question or an interpretation question, or, as it was in the last exam, a combination of both. Prepare the cash flow and then interpret it, or interpret bits of it. So this will come up, probably. The purpose of a cash flow statement, a statement of cash flow, they changed the name at the same time as they changed the name balance sheet to statement of financial position. Because people don't understand what a balance sheet does. So they've changed it to a proper title, statement of financial position. And they changed income statement to statement of income with an additional bit or a combined bit, the statement of comprehensive income, because people didn't know what profit and loss or income statement was. So it's now a statement of income. And cash flow statements is what they used to be called. People didn't understand that, so they changed the name to statement of cash flow. It's a lot more clear, a lot more easily understood. So here we are with statements of cash flow. I remember these being introduced long time ago. Rolls-Royce, Britain's manufacturer of premier motor vehicles, announced record profits one year. The year to March, they announced wonderful profits. Never before have they done that. And 6 months later, they were in liquidation. And how can that happen? How can you make record profits in 1 year and then within 6 months you're in liquidation? And the answer is with them, they were spending a lot of money on development and they were capitalizing the development expenditure. And it meant that all the money was going out developing these new models, so they were keeping it away from the income statement. And therefore the income statement was quite rightly showing good profits. But if they had expensed the development expenditure, then you could then see that the company was in deep trouble. And a cash flow statement was therefore designed. It was determined that cash is probably more important than profit. That people understand cash because people deal with cash on an everyday basis, whereas they don't understand profits and losses. So cash flow statements in those times, a long time ago, therefore became a primary statement within a set of financial statements.
But in the cash flow statement, they show the negative balance.
That's the important bit. The cash flow statement can show whether there's been a positive or a negative cash flow. And that then gives you a better indication. If you think about when I show the highlights or the elements of a cash flow statement, the interpretation of that, and when we do the big example at the end, the big interpretation says, is the company generating enough cash from its operating activities in order to be able to finance its investing activities? And if it's not, where is it getting the money from? It presumably is getting the money from issuing more shares or from borrowing more money. And that item will be shown within the financing activities section of the cash flow. So just by looking at 3 prime figures within the cash flow, you can interpret quite a bit about the company's ability to continue its investment program. Okay? And you're right, incidentally, that somewhere within the last three figures, there will be negative cash. It will either be negative cash for the year, or it will more likely be negative cash brought forward or negative cash carried forward. And this is one little trick of the examiner, something that he does. The bottom three lines are net cash flow for the year, and then you add on to that the cash and equivalents brought forward from last year, and that should give you cash and equivalents carried forward into the next year. What he will do, and he invariably does, is that in 1 year, the brought forward year, probably he will have an overdraft brought forward, and then in this year, this current year, it will be a balance at bank the right way. We've got positive cash. It might be the other one. It might be positive cash brought forward and an overdraft carried forward. And you've got to be careful that you get the sign right, because if you put it positive brought forward and positive carried forward, then your cash flow statement is going to be wrong. Your net cash flow for the year will be incorrect. So that's something that normally I would say to you on a revision course rather than now. That was a general chat really about cash flows and the importance of cash flows. They're recognized as being a primary statement. Some would argue, and I think I could have a great deal of sympathy for the argument, some would say that a cash flow statement is rather more important than an income statement, showing profits and losses on an accruals basis. I would have thought cash flow was probably more important than that, because it's showing where cash is being received from, generally, and therefore where it's also being paid to. And you can determine, therefore, whether the company is becoming more cash strong or less cash strong. That would be my view. The purpose then is to show the effect of an entity's commercial transactions on its cash balance. One of the purposes, again, within that, and it's possibly a different way of saying that top line, is to reconcile profit before tax, which is arrived at on an accruals basis, and it's reconciling that to cash generated from operations. In simplistic terms, profit would suggest an inflow of cash. It is simplistic because it doesn't necessarily follow. But if you're making profits, then presumably you've got an inflow of cash. But the profit is on an accruals basis. Profit is calculated on the basis of sales made and purchases made, whether or not we've paid for them. So we do have to go through a reconciliation exercise to arrive or to get from the accruals-based profit to the cash-based inflow or outflow. And that's what the top section of the cash flow statement of cash flows is going to do. It's thought that users can readily understand cash flows as opposed to comprehensive income and statements of financial position. And those we know already, those are capable of manipulation by using different accounting policies and creative accounting and creative use of those areas of divergent possibilities. What were those areas called? Oh, the penumbral areas of divergent possibilities. That's right. Cash flows are used in investment appraisal methods such as net present value. And therefore, a statement of cash flows gives potential investors a better chance to consider the performance of a business. A statement of cash flows, the top line is profit before tax. And then there are three subdivisions. There's a subdivision called operating activities. And then about halfway down your A4 page, about halfway down your exam booklet, you then need to write investing activities. And then maybe 3/4 of the way down you need to write financing activities. And on the last 3 lines of your page, you have these. Net cash flow for the year. Added to which will be cash and cash equivalents brought forward. and that will give us cash and cash equivalents carried forward. So the first figure you're going to put into your answer is this profit before tax. It's easily found. You know where it is. It's towards the end of the income statement. Profit before tax, point number 1. What's the second figure you're going to put in? What's the second figure you're going to put in? The second figure you'll put in is down there. Cash and cash equivalents brought forward. And the third figure is there. Cash and cash equivalents carried forward. The fourth figure is therefore this one. Net cash flow for the year. Never mind what's happened during the year. Never mind about depreciation and movements on provisions and changes in working capital. Never mind about those. These are the figures you should put in first. Because these are definite. These are right. All your others, they could be anywhere. They could be pluses, minuses, in brackets. They could be wrong figures, transposed. But these figures are right. And when you get down to there, and when a marker gets down, when a marker has got your cash flow, statement of cash flows in front of him, he's going to be looking at those bottom 3 figures to see whether, okay, those bottom 3 figures are correct. Well, you know they're correct. Doesn't matter. Doesn't matter what these other 3 figures up there add up to. It does not matter that they don't add up to this figure here. Whatever you do, you must not change that figure. Because 100% certain that's right and that's right, therefore that must be right. Even though all these other figures above, even though they may all be wrong, you know that that one is right. Little bit of exam technique. It's called cheating. But it's like sort of acceptable cheating. Okay, so we've done the easy bits. Now we need to go back up here. Just back to your notes for a moment. Cash flow from operating, cash flow from investing, cash flow from financing. Cash itself, down at the bottom there, cash and cash equivalents. Cash is cash on hand and demand deposits. What about overdrafts? Is that cash or is it financing? Depends. Depends on the nature of the overdraft. If it's a long-term overdraft, if it was $1 million brought forward overdraft, and it's 980,000 overdraft carried forward, it would seem to be in the nature of long-term financing. But if it's a working type of overdraft, if it's just a sort of temporary blip and we've gone into overdraft, last year we were positive, this year we're negative, next year we might be positive again. If that's the sort of overdraft it is, then it will be down in the bottom of cash and cash equivalents. As a general principle, I always include the overdraft as a cash or cash equivalent. So I have negative cash carried forward or negative cash brought forward. But that's the way I do. It's up to you. If you want to assume it's financing, well, then you do so. But beware, because I've already said 2 minutes ago that it's normally the case that he will change the sign of the cash from last year to this year. Sometimes it will be positive brought forward, negative carried forward. So it would seem that it's more in the nature of cash and cash equivalents than it is long-term financing. Cash equivalents, short-term, highly liquid investments, readily convertible to known amounts of cash, subject to an insignificant risk of change in value. Short-term, define short-term. What's short-term for you? Could be long-term for me. So we need a definition. We need some sort of line in the sand that says within this period it's short term, beyond that period it's long term. And the line in the sand is drawn at 3 months. If it's convertible, readily convertible into cash within 3 months, then it's short term. But what if it's 3 months and a day? What if it's the 1st of April? Well, come on, it's only a minute, isn't it, between midnight on the 31st of March and 1 second past midnight on the 1st of April. If it's short term at 31st March midnight, surely it's got to be short term in April. Well, if it is, what about 10 past midnight? What about 4 o'clock in the morning, 1st of April? Is that still short term? What about noon on the 1st of April? Or close of business on the 1st? What about the 2nd of April? Is that short term? It's only a day and a bit beyond the 3-month line. Is that short term? Draw the line in the sand. 3 months, short term. More than 3 months, long term. Ready conversion is normally taken to be convertible into cash within 3 months after the statement of financial position date. There we have on page 130 our sort of pro forma. It's using the indirect method. I did mention to you this morning when we were talking about those areas of different, what's the expression I'm trying to remember? Those areas of different treatments. What's the expression? That accounting standards reduce the number of areas of different possible treatments. No, that's not what I was saying. What was it? Reduce the penumbral areas of oh, help me, come on, don't sit there looking like a lump of cabbages. Divergent possibilities. Reduce the penumbral areas of divergent possibilities. That's right. Well, I told you this morning, the benchmark for preparation of cash flows, the benchmark treatment is the direct method. He has never asked for you to use the direct method. He always asks you to use the indirect, the allowed alternative. In fact, the only time I remember recently that he's mentioned direct method was part B of question 3. Question 3 was 20 marks for the statement of cash flows, and then part B of question 3 said, for 5 marks, if benchmark is direct method, why do most companies use the indirect method? It's 5 marks. You need 5 things to say. Easier is one of them. But you've still got 4 more to go. So far you're only on 20%. Get me up to 40%. Give me another one. The numbers in the indirect method, or the indirect method therefore, can be prepared from an existing set of financial statements, from the statement of financial position plus the statement of comprehensive income. With the direct method, you need a little bit more information. So it's easier to reconcile the financial statements to the statement of cash flow using the indirect method. That's 2 marks. You're up to 40. Get me to 60. Come on, I want 60% from you. Go on. But on the basis that most companies use the indirect method, then it becomes more readily comparable because most companies use the indirect method. Yeah, okay, it's more readily comparable with other companies who are also using the indirect method. I'm up to 60, I want 80. If we do what?
If we do this indirect method, so the users of this cash flow, they can get more information.
Do you know, I'm not sure that's right. I think probably the direct method will give you more information. Yeah. But just continuing from your first point, it's easier, therefore it must be quicker. And if it's quicker, therefore it's going to be cheaper. There's your 5 marks. Another one. Going back to this legal opinion about the role of accounting standards in determining truth and fairness, Another quote from these law people who came up with that wonderful different possibility treatment. What's the expression? It reduces the opportunities for treating similar things in different ways. What's that expression I'm trying to remember? Reduces the penumbral areas of divergent possibilities, yeah. Another statement that these barristers came up with was that people expect to receive what they usually receive. And if what they usually receive are financial statements in compliance with accounting standards, then they expect to continue to receive financial statements which comply with accounting standards. And if the auditors feel that those financial statements show a true and fair view, then to continue to comply with accounting standards is to continue truth and fairness. People expect to receive what they normally receive. If it's your habit, if you grew up knowing that Friday dinner time was going to be fish, then you expect fish on Friday. And instead, if you get a piece of meat, a piece of steak in front of you on a Friday, whoa, what's happened now? Where's my fish? You expect to receive what you normally receive. And if what you normally receive complies with accounting standards, then to continue to comply with accounting standards is to continue true and fair. That's a bit of legal reasoning. So statement of cash flows is using the indirect method. This is the indirect method of presentation. I'm not going to write it all out again on the screen, but I will make comments as they hit me. We're going to start with net profit before taxation, and we're going to reconcile this accruals-based figure with a cash-based figure. We're going to arrive at a cash-based figure. And in doing that, we need to add back. They will have been deducted as expenses some non-cash items, like depreciation. And if we've got depreciation added back, and this is an add back, it has been deducted and arriving at profit, so we need to add it back to profit before tax. What's the equivalent of depreciation for an intangible asset? Amortization. What's the equivalent of depreciation for goodwill? Impairment. So if you're adding back depreciation, you must also be adding back amortization and impairments. Investment income. It's in the wrong place there. Investment income will be on an accruals basis. That is, we will have anticipated an income even though we may not have received it. So investment income needs to be deducted. We will have added it to our profits in arriving at profit before tax. We therefore need to deduct this accruals-based investment income figure. And correspondingly, the interest expense. If you had done that lease example, Giudruolo, over lunchtime, you would have seen that there was finance lease interest within Giudruolo's income statement, but she doesn't pay that until tomorrow, until the 1st of January. So it was included within the year to December as an accruals-based charge. But we're not interested in an accruals-based charge. We want cash payments. So you would add back the interest which is included within probably in the finance charges of the statement of comprehensive income. That needs to be added back because it's accruals-based, not cash-based. Also add back, and it's not shown within this inverted commas pro forma, also need to add back any losses on asset disposals. If we've sold assets, and if the cash flow question comes up, there will be an asset disposal. There will be. And it will be at a profit or a loss. It certainly won't be for book value. So we need to add back any losses on asset disposal. And correspondingly, we need to deduct any profits on asset disposal. The first set of three, which I've just said, were depreciation, amortization, and impairments. That was our first threesome. And in fact, there are three threesomes within this top section. The first one, depreciation, amortization, impairment. The second one is changes in working capital. Increases and decreases in inventory, receivables, and payables. I think one of the problems, and certainly a problem I had when I was a student, and it seems to continue through even a generation or two since I was a student, it does seem to me that people do have problems with brackets, whether to put things in brackets or not. And I think the sensible thing to think is in terms of inventory. Just imagine inventory. Just concentrate, focus on inventory. If I start with 80 items in inventory, and I finish with 50 items in inventory, and I haven't bought any inventory during the year, what must I have done? If I started with 80 and I finished with 50, what must I have done? I must surely have sold 30 items of inventory. Well, if I've sold 30 items, that's money coming in. So a decrease in inventory is an inflow of cash. Do it the other way. I start with 20, I finish with 60. I didn't sell any. What must I have done? I must have bought 40. That's an outflow of cash. I must have paid money out to buy 40 units in. Now, instead of dealing in units, put some zeros behind that, and you're now dealing in dollars. So if you will accept that an increase in inventory is an outflow of funds, you must also accept that inventory is not really any different than receivables. Receivables is the same, isn't it, as inventory? It's just one step round the circle of these rotating assets. So an increase in receivables is an outflow of funds. An increase in receivables is an outflow of funds. Look, at the moment, Natalia owes me $10. Now she owes me 15. What happened to my funds? What happened to my funds? They went down, didn't they? So an increase in receivables is an outflow of funds. What, therefore, do you think an increase in payables is? Think of it from Natalia's point of view. She did owe me 10. Now she owes me 15. What's happened to her funds? What's happened to her payables? So an increase in payables is an inflow of funds. Just reduce it to basic common sense logic like that. Now I've got my rotating assets here. I've got inventory which I sell to receivables. I convert the asset into receivables. And hopefully my receivables will pay me cash. And sometimes some of that cash is going to go to my suppliers. And the rest of the time it's going to go to inventory. And there's my rotating assets. Inventory converts to receivables, converts to cash, converts to inventory. And the more often, the more frequently you can get round that circle, the more opportunities you get to make profits. How much profit do you make when your cash is spent to buy more inventory? How much profit am I making on that little bit of the transaction, in that arc of the circle? How much profit do I make when I spend cash and buy inventory? Nothing. What about when my receivables pay me cash? How much profit am I making there? When my receivables pay me cash, how much profit is there in that transaction? Nothing. What about profit when converting inventory to receivables? That's when I make my profits. So the faster I can turn my inventory over, the more often, the more frequently I can turn my inventory over, the more opportunities I get to make profits. And if I can cut these people out, if I can just go inventory, cash, I can go zipping around there, I could be dizzy. I used to live next door in the UK. I used to live next door to a man who had a stall on a market, and he sold fresh fruit and vegetables. A sort of quality neighbour. He sold fresh fruit and veg. He was married, he had 5 children, 8 grandchildren. He also drove a Rolls Royce. His wife drove a soft-top convertible Mercedes. All his children had cars. 4 of them worked in this business. He was a market trader. And he used to buy. He didn't even buy for cash, he bought on credit. His circle was here. He used to buy on credit, sell for cash, and pay his suppliers a month and a half later. He's got 45 days of sales, pure cash, available for him. All his grandchildren were in private school, private education. Costing, at the time, about £6,000 a year. 8 of them. 48 grand, 50,000 paid on private education. A big flash Mercedes for his wife. Cars for all his children. Big Rolls Royce for himself. Heated swimming pool in the back garden. And he left the heat on all winter, and I used to stand in the snow looking across the fence at his steam coming up from this, and all because he's got 45 days worth of sales to himself. And then he'd pay the suppliers. On a daily basis, he'd pay the suppliers, he'd get more goods from them, sell them at a profit, keep it, and then just pay the suppliers every now and then. Cash is wonderful. So that was his way. He used to do that, and then pay a bit of cash. Okay. How did I get there? No, a decrease in inventory. A decrease in inventory is an inflow of funds. An increase in receivables, an outflow. A decrease in payables. I owe Natalia, I owe her 36. If I give her 5, what's happened to my cash? So a decrease in payables is an outflow of cash. An increase in payables, I owe her more. Therefore, she has given me some more money. And then we get the last threesome. And you might want to argue with me here, I don't know. The last threesome is interest paid, taxes paid, and dividends paid. Interest, tax, and dividends. First threesome you can remember by depreciation, impairment, amortization, not applicable. Just remember Diana. Your second threesome is changes in working capital. It's this circle here. Well, it's not actually. It's inventory, receivables, and suppliers. The working capital, the 3 elements of it. The third threesome, interest paid, tax paid, dividends paid. And that will give us net cash flow from operating activities. Sorry, Tom, you had a question. You did, but you've forgotten it. You did, but I explained it. You did a lot of talk. I'm sorry. I'll shut up. I'm sorry, Tom. Am I keeping you awake? I'll talk quieter for Tom's sake. All right, so that gives us net cash flow from operating activities. I thought you might want to argue with me about the dividend treatment. The dividend sees that there's an asterisk there. Down at the bottom under cash and equivalents at the end of the year, it may alternatively be shown as a cash flow from financing. My approach to this is that everything goes into operating by default. And then we only need to remember 1 or 2 things in investing. We only need to remember 1 or 2 things in financing. And literally in the exam I would be surprised if you got more than 3 elements in financing. I'd be astonished if you got more than 4 elements in investing. And so everything else goes into this top section. So I would put dividends paid up at the top. If you want to put them at the bottom, that's fine. They can still go in financing if you want. But I wouldn't. I would always put them in operating. That gets me on to the second section, the second subsection, cash flows from investing activities. Money, cash, dollars, spent buying tangible non-current assets. Tangible non-current assets have increased. It may be that they've increased because we've signed a finance lease. That's not cash. We could have increased our tangible non-current assets by 17,500 like we did in that other example before lunch. No cash there. Well, there is, but there's not much cash there. There's one installment and a deposit, that was all. So increases in tangible non-current assets, property, plant and equipment, is not necessarily going to be cash. It may be finance lease. It may be revaluations. If I were to write this on the screen, I would have written in red, beware. Beware the revaluation account. Because that will have moved, probably, because we've revalued the assets during the year. Beware the revaluation account. Does what go in there? Revaluation doesn't go anywhere. If you look in the statement of financial position, last year and this year, you will see the revaluation reserve. And it will have moved, probably, it will have moved. And the only reason it's moved is because we've revalued the assets. So the change in assets from last year to this year, part of that change is due to the fact that we've revalued assets. Okay? So it doesn't go, it's a non-cash movement. It's just a book adjustment, debit assets, credit revaluation. So there's no cash involved, so it doesn't feature in the cash flow statement. It features by default in the fact that your movement in TNCA will be affected by it. Tommy had a question.
Yeah. Dividends received.
Not there yet, Tom. I'm just about to get down to the last one on the investing activities. Okay, just let me go back up to operating 1 second. Just mentally go back up to operating expense. Do you see we added back the interest charge and then we deducted the interest paid? Okay? And still within operating, we deducted investment income, and then in investing activities we've got investment income actually received. Those two items within the operating section, those are arrived at on an accruals basis. And we're not interested in accruals. We're interested in cash. Money. Money. No matter how long I've lived away from the UK, I can't lose that O sound. Money. It's a northern English accent. And I do try and reduce the effect of my accent, but I can't lose that O sound. One student asked me down the road, he said, will you say a sentence for me today in lectures? I said, yeah, what's the sentence? Company budgets must show money. I just can't lose it. You must listen to me. Cash flow from investing activities. Purchases of property, plant and equipment. How much cash did we actually pay? And proceeds from sale. Not interested in profits and losses on sale. I want to know how much money I received. How much money? Interest received. This is investment income. Dividends received. Again, more investment income. Tom, do you still have a question? Don't worry about it. That's P2. There will be no consolidated cash flow in F7. It's a P2 topic. Specifically, it will not be in F7. No consolidated cash flows. It's P2. So that gives me cash flows from investing activities. What about cash flows from financing activities? Well, there's not likely to be more than 3 here. There will be probably proceeds from a share issue, probably a new loan or the repayment of an old loan, and possibly cash payments to finance lease creditors. But that's it in financing. Cash paid. The capital element of the cash paid to finance lease creditors. Compare finance lease creditors brought forward with finance lease creditors carried forward. adjust for any new finance leases that we've bought. The difference has then got to be cash payments. You'll have finance lease creditors. You'll see them 4 times on the statement of financial position. The word finance lease creditors, or that figure for finance lease creditors. There'll be in current liabilities, and there'll be in long-term liabilities. Oh, I'll put some figures on. Don't put X's, I'll put some figures in there. And you're told that we bought a new asset, a fair value. We bought it on finance lease. It has a fair value of 40,000. How much cash did we pay the finance lease creditors? New asset, we bought it on finance lease, the fair value is 40,000. How much have we paid to the finance lease creditors? We did owe 68 and 160. We did owe 228. We bought 140. We bought 140. So now we owe 368. But we know we don't owe 368. We can see what the new liability obligation is. The liability carried forward into next year is 256. Therefore, I must have paid 112. If I had paid that and that in full, I would have paid 368. But I know I haven't paid them in full, because I still owe 256. Therefore, I must have paid them 112. T accounts, 68 brought forward, 160 brought forward. 140 additional, just bought. Debit TNCA. Carry forward, 74. Carry forward again, 182. Therefore, cash must be 112. You don't look like a happy group. Is that a problem? And not the fact that you don't look happy. Is this a problem on the screen? Okay. Down at the bottom within financing activities, remember in investing activities, I said I have written, and you have written, beware the revaluation reserve. Down in financing activities, can you write, beware the share premium account? Beware the share premium account. Beware share premium. Down in financing, proceeds of share issue. Proceeds of issue of share capital. Just write against that, beware the share premium account, because that's also part of the proceeds of an issue of shares. Note 1 at the bottom. I suppose technically if you're going to go for the global prize in F7, then you'd put this note in. Any substantial transactions ought to have an explanatory note to them. And there ought to be a reconciliation of the movement of cash in hand balances with bank short-term deposits. There ought to be that little bit right at the bottom of the page there.